If you're navigating a divorce in Washington state, there are several financial concepts that become critically important, especially for high net worth families. Divorce is one of the most financially disruptive events that a person can experience. Because of that, it becomes critical to understand your financial position as early as possible in the process. When you gain clarity around your assets, cash flow, taxes, and long-term financial picture, you're better positioned to make thoughtful decisions and regain a sense of control that is often lost during the legal and emotional intensity of divorce. Today, I want to walk through 3 financial concepts that high net worth individuals should understand early in the divorce process, especially when retirement accounts, investment portfolios, executive compensation, or inherited assets are involved. Washington is a community property state, which generally means that assets accumulated during marriage may be considered jointly owned by both spouses. One important point here is that title alone doesn't necessarily determine ownership. I've seen situations where one spouse assumed that a retirement or a brokerage account was entirely separate because only one name appeared on the statement. In reality, contributions made during the marriage, and in some cases growth tied to those contributions, may still be considered community property. For example, if a 401k grew significantly during the marriage through salary deferrals, employer matching, and investment appreciation, a portion of that account may ultimately be subject to division. This is why understanding the history and funding of each account early in the process becomes so important. Another important concept in Washington divorce law is that courts aim for what is called a just and equitable division of assets. Now, many people interpret that as a strict 50-50 split, but financially, it's often more nuanced than that. Tax differences, liquidity, future income potential, concentrated positions, all of these things need to be taken into account. $1 million in a traditional IRA is not economically identical to $1 million in a taxable brokerage account or cash. Future tax liabilities matter. Liquidity matters. Risk exposure matters. This is where careful financial analysis can become extremely valuable during divorce negotiations, particularly for families with substantial retirement assets, business interests, or concentrated equity positions. The third area I encourage people to pay close attention to is asset classification and complexity. Certain assets require significantly more analysis than people initially realize. Let me just walk through a couple examples. Often termed executive compensation, RSUs, or stock options and deferred compensation plans, these can become particularly complicated because ownership may depend on when awards were granted, when they vested, and what period of employment they were intended to compensate. Inherited assets can also create confusion. In some situations, inherited property remains separate. However, commingling inherited funds with marital accounts can complicate the distinction. I often tell clients that once assets begin mixing together, over time, tracing them becomes much more difficult. The earlier you understand the character of each asset, whether it may be considered separate, community, taxable, liquid, or subject to other restrictions, the better positioned you are to make informed financial decisions during this process. Divorce is obviously an emotional transition, but it's also a major financial transition. Decisions made during this period can affect long-term wealth, retirement planning, taxes, and cash flow for many years afterwards. Taking the time to understand the structure and implications of your financial assets early in the process can make a meaningful difference. I'm Dr. Brock with Kimball Creek Partners, and until next time, make it meaningful.